Here is something nobody tells you at the start of this conversation. Both guys win. And somehow, that is the most frustrating answer you will ever hear, because winning looks completely different depending on which path you took to get there. One man is sitting on a paid-off property worth $500,000. The other has a brokerage account with a similar number. But one of them spent his weekends fielding tenant complaints, coordinating plumbers, and losing sleep over a roof that needed replacing. The other one went hiking, same destination, wildly different journey. And the journey, it turns out, costs more than most people realize. This is the conversation that the real estate versus stocks debate has been avoiding for years. Not because the numbers are hard to find, but because both sides have a financial incentive to make their answer look better than it actually is. The real estate guy is selling a course. The index fund guy is running a YouTube channel. Neither of them is going to lead with the part that makes their argument look weak. So that is exactly where we are going to start. Two men. Same age, 30 years old. Same city. Same $50,000 sitting in their bank accounts. Same $55,000 annual salary. Identical starting points. The only thing that separates them is one decision, made once, on one afternoon. What to do with that 50 grand? Everything else that follows flows entirely from that single choice. The first man, let's call him Jake, decides to buy a rental property. He puts that $50,000 down as a 20% deposit on a $250,000 house. 3-bedroom, decent neighborhood, the kind of place a young family would be happy to rent. His mortgage comes out to a 30-year loan at 7% interest. Monthly payment lands at $1,330. He finds a tenant quickly and locks in $1,800 per month in rent.
The math on paper looks almost embarrassingly simple. $1,800 coming in, $1,330 going out. $470 every single month, pure cash flow, just sitting there. Jake tells his friends. His friends are impressed. He drives past the property on the way to work and feels something that is genuinely hard to describe unless you have owned something real. That house is his. He can see it. He can touch it. The second man, Marcus, takes that same $50,000 and deposits it into a total stock market index fund. No leverage. No tenants. No late-night calls. No physical thing he can drive past. He sets up an automatic $300 monthly contribution and then, in a move that will prove to be either brilliant or boring depending on how you look at it, he basically forgets it exists. When colleagues ask about his investments at lunch, he says index funds. They nod. Someone changes the subject. Marcus is not the interesting investor at the table. He knows it and he genuinely does not care. Now before the numbers start, there is something critical happening here that almost no financial comparison ever acknowledges properly. The emotional experience of these two investments is so dramatically different that it actively shapes the financial decisions both men will make going forward. Year 1 for Jake feels like a dream running exactly on schedule. Rent arrives on the 1st of every month. He is deducting mortgage interest and depreciation on his tax return. Every indicator points in the right direction. Marcus, meanwhile, logs into his account every few months and watches a number move. Year 1, his $50,000 has grown to around $55,000. Year 2, maybe $61,000. There is no story to tell. Now here is where the spreadsheet starts pushing back against the fantasy. Let's run the real numbers through year 3, not the thumbnail numbers, the actual ones. Jake has collected $64,800 in rent over those 3 years. His mortgage payments add up to $47,880. Subtract one from the other and you get $16,920 in gross cash flow. That is the number that ends up on the barbecue conversation highlight reel. That is the number your landlord friend quotes when he explains why real estate is the only real path to wealth. That number is technically accurate. It is also deeply misleading. Property taxes, roughly $3,000 per year, total $9,000 over 3 years. Insurance, $1,500 annually, another $4,500 gone. The water heater gave out in year 2, $1,200 to replace. A roof leak showed up in year 3, $2,800 to repair. He had one vacancy month between tenants. Jake manages everything himself to avoid the management fee, which means weekend showings, maintenance coordination during his lunch break, and fielding calls at 11 at night when the heating stops working. He is not compensated for any of that time. Strip all of that out and Jake's actual net cash flow over 3 years sits somewhere between $2,000 and $4,000. Not $16,920. Between $2,000 and $4,000 over 36 months on a $50,000 investment. Marcus by this point has invested his original $50,000 plus $10,800 in contributions. At the historical average annual return of around 10%, his portfolio is sitting at approximately $76,000. He has put in 0 weekend hours. He has fielded 0 emergency phone calls. But Marcus does not have what Jake has. Jake used $50,000 to take control of a $250,000 asset. That 5-to-1 leverage ratio is the single most powerful structural advantage real estate holds over stock market investing. Vacancy. The average rental property sits empty for roughly 1 month every year. During that month, the mortgage payment is still due. And you are spending your own time cleaning, listing, showing, and screening, maintenance and repairs. The standard benchmark is 1 to 2% of the property's value per year. Some years it is a $150 faucet repair. Other years it is a $7,000 HVAC system that breaks in August with a tenant threatening to break their lease. Capital expenditures. Roofs last 20 to 25 years. Furnaces run for 15 to 20. Water heaters quit after 10 to 12. These are not surprises, they are scheduled certainties. And they arrive in large lump sums of $5,000 to $15,000 at a time. If Jake hires a professional manager, 8 to 10% of monthly rent disappears immediately. On $1,800 per month, that is $150 to $180 gone before he even starts calculating expenses. One costs dollars. The other costs hours. A tenant who understands the eviction process can stop paying rent and remain in the property for 3 to 6 months before you can legally remove them. It happens to experienced landlords. It happens at every level. By year 5, Jake is fully immersed in the reality of property ownership rather than the idea of it. He is on his 3rd tenant. He has replaced the roof for $8,500. He navigated a plumbing emergency that cost $1,400 on a holiday weekend. His actual cash-on-cash return, calculated honestly after all real expenses, is hovering somewhere between 3 and 5%. That is not a bad return. But it is not the 15 to 20% he was casually quoting to his friends at dinner 2 years ago. Marcus has now been doing essentially nothing for 5 years. By year 7, with his consistent $300 monthly contributions continuing on schedule, he is sitting at approximately $135,000 to $150,000. The compound growth has now crossed a threshold where the returns on his existing gains are generating more new wealth each year than his original contributions ever did. The machine is feeding itself. By year 10, Jake's property has appreciated to between $335,000 and $350,000. His remaining mortgage balance is approximately $166,000. That puts his total equity at roughly $170,000 to $184,000. Marcus's portfolio with those steady $300 monthly contributions is sitting at approximately $165,000 to $180,000. His total contributions across the entire period come to $86,000. The rest is entirely compound growth. Jake's entire real estate wealth is concentrated in a single asset in a single neighborhood in a single city. One local economic downturn, one major unforeseen structural issue, and the gap closes or reverses entirely. Marcus is invested across thousands of companies spread across multiple industries and multiple countries. His downside is diversified in a way Jake's investments simply cannot be. He has not lost a weekend in 10 years. We are getting to year 20 now, and this is where the numbers genuinely start to tell a more complete story. Pay attention here, because the most important insight in this entire comparison is not the final totals. By year 20, Jake's property is valued somewhere between $450,000 and $500,000. His mortgage is either fully paid off or within striking distance of it. His total equity lands between $400,000 and $500,000. After 20 years of maintenance costs, repair bills, tenant turnover cycles, tax payments, and the ongoing investment of his own time, his total net cash flow above what he spent sits somewhere between $50,000 and $90,000 over the full 2 decades. Marcus's portfolio at a 10% average annual return with $300 monthly contributions running the entire time has grown to approximately $420,000 to $460,000. No debt carried. No tenants managed. No emergencies handled. No 2 a.m. phone calls ever answered. At the 20-year finish line, both men have built genuine wealth. The totals land in similar territory, somewhere in the $400,000 to $500,000 range. But the experience of getting there is so fundamentally different that calling it a tie feels almost dishonest. Jake worked for his wealth. Marcus waited for his. If Marcus had increased his monthly contribution by just $200, moving from $300 to $500 per month, his 20-year portfolio would land at approximately $550,000 to $600,000. That single modest adjustment pulls his outcome cleanly ahead of Jake's. Market volatility is real, and it is not just uncomfortable, it can be genuinely devastating to people who are not emotionally prepared for it. In 2008, the total stock market dropped approximately 37%. In March of 2020, it fell 34% in the span of a single month. Picture Marcus in early 2020, watching a portfolio he has spent a decade building drop from $150,000 to somewhere around $95,000 in 4 weeks. That is a paper loss of $55,000 in less than 30 days. Index funds do not send a monthly payment to your checking account the way a rental property does. A total market fund generates a dividend yield of roughly 1.5%. On a $150,000 portfolio, that is approximately $200 per month. That is not income replacement. Real estate investors can claim depreciation, deducting a calculated theoretical decline in the building's value from their taxable income every single year, even in years when the property is actually increasing in value. That is a legally sanctioned tax shelter that has no equivalent in standard stock market investing. Real estate works clearly and powerfully in specific circumstances. If you are in a local market where monthly rent on a property is at least 0.8% of the purchase price, the cash flow math starts working in your favor from the beginning. Index fund investing works clearly and powerfully in a different set of circumstances. If you want total simplicity, broad diversification, complete liquidity, and zero ongoing management time, consistent long-term investment in low-cost index funds will build comparable or superior long-term wealth. And if you can do both, maintaining a well-chosen rental property in a genuinely strong rental market while simultaneously investing consistently in index funds, the mathematical outcome of that combined approach outperforms either strategy running alone.
But all of that only matters if you include everything in your calculation. Not just the rent minus the mortgage. Not just the historical average stock market return. Everything. The vacancy months. The roof replacements. The tenant who stopped paying.
But all of that only matters if you include everything in your calculation. Not just the rent minus the mortgage. Not just the historical average stock market return. Everything. The vacancy months. The roof replacements. The tenant who stopped paying. Because the answer that leaves anything out is not an honest answer. It is just a better-looking version of being wrong. And being wrong about this particular question, over a 20-year horizon, is a genuinely expensive mistake to make.